You know, when the economic forecast feels a little uncertain, getting a clear picture of how major players are navigating the landscape becomes, well, incredibly valuable. It's sort of like trying to understand the movements of a big ship, gives you clues about the currents, potential challenges ahead.
Precisely. And that's exactly what we're doing in this deep dive. We're focusing on the recent Infosys Q4 FY25 earnings call and their press conference. Think of it as getting a really focused look inside a leading IT services company, understand their performance, and what their perspective means for the broader tech ecosystem.
Right. We've gone through the transcripts, both the press conference and the earnings call that followed their board meeting on April 17th, 2025. All the official details are up there on the Infosys website if you, the listener, want to dig even deeper later.
And it's key to remember, Infosys is a significant force in IT services, a major player. So their results and what their leadership communicates really offer a vital snapshot. It tells you a lot about the sector's health and direction.
So our mission today is basically to cut through the corporate speak, pinpoint the most important insights from Infosys. We want to understand their view of the market now, their plans, and present it clearly, concisely. Hopefully give you a real understanding of what's going on. Okay, let's unpack this. Maybe start with their overall performance in FY25.
Yeah, good place to start. So for the entire fiscal year 2025, Infosys reported solid 4.2% growth in revenue. That's in constant currency, adjusting for fluctuations. They also kept a strong operating margin, 21.1%, and generated a significant $4.1 billion in free cash flow. And on top of that, $11.6 billion in large deals signed through the year. They see this as a strong overall showing.
Interesting. And looking at that yearly growth, were there specific parts of their business that really stood out?
Yes, actually, it's worth pointing out their financial services segment and also what they call URS, that's Europe, Rest of World, and strategic clients plus manufacturing. All of those segments saw growth rates higher than the company average for the year. So particular strength there.
And profitability, keeping those margins healthy, that's always a balancing act in this industry, right?
Absolutely. And even though they face some headwinds, the full year impact of earlier pay rises, higher variable pay, costs from ramping up those big new deals, some acquisition impacts. Despite all that, they actually improved their operating margin by 50 basis points for the full year, which is quite a notable achievement given those pressures.
Okay, so a solid year overall. Now let's hone in a bit more. Q4 FY25, what did that performance look like?
Right, Q4. So the fourth quarter of FY25, they managed year-on-year revenue growth of 4.8%, again, in constant currency. And they kept that operating margin healthy at 21%. So compared to Q4 the previous year, still positive momentum.
But I think I remember reading something about revenue declining compared to the previous quarter, Q3. What was behind that?
Yes, that's right. When you compare Q4 to Q3, revenue did dip by 3.5% in constant currency. They said about two-thirds of that drop was due to a reduction in what they call third-party costs and the revenue tied to that. Seems some deals slipped, got pushed out. The other third, that was more down to volume decline and, typical seasonality. Fewer working days in Q4 compared to Q3.
Fewer working days. Okay, that makes sense. Now, Europe seemed like a real bright spot. Sounded like a strong year there.
It really was. For the full fiscal year, their Europe revenue growth in constant currency was a very impressive 15%. That was driven by growing existing client relationships, client mining, they call it, ramping up large deals they'd won earlier, and contributions from companies they acquired in Europe. Europe's now a big piece of the pie for them, 30% of total revenue.
That is substantial. What about specific industries in Q4? Any still showing strong results then?
Yep. Financial services and manufacturing kept up their strong performance. Both reported double-digit year-on-year growth in constant currency in Q4. It was 12.6% for financial services and 14% for manufacturing. So those key sectors stayed pretty robust.
And the lifeblood for these firms winning new business, how did the deal-making look in Q4 and for the full year?
They closed 24 large deals in Q4. Total contract value, or TCV, was $2.6 billion. And a healthy 63% of that was net new work. For the full fiscal year, it was 96 large deals, TCV of $11.6 billion, and 56% of that was net new. So still demonstrating a strong ability to win big contracts.
Anything else jump out from their Q4 performance?
A couple of things, yeah. They managed to reduce their DSO days sales outstanding, both compared to Q3 and even including unbilled amounts. Lower DSO is generally good, means they're collecting cash from clients faster. And as we mentioned, that record high free cash flow for the full year, $4.1 billion.
Record free cash flow. Always good to see. Okay, good look back. Now, let's pivot forward. What guidance did Infosys give for FY26, and what's their read on the market now? This is where it gets really interesting, I think.
Okay, guidance for FY26. The revenue growth forecast is in the range of 0% to 3%. Again, constant currency. It's quite a wide range. And they were pretty explicit that this reflects the considerable uncertainty they're seeing out there in the economic environment.
Uncertainty certainly seems to be the word of the day. What specific factors are feeding into this more cautious outlook?
They mentioned several things, and it echoes what we've heard from competitors like TCS and Wipro, too. Things like clients taking longer to make decisions, a slowdown or even pausing of those big transformational projects, and potential impacts from upcoming regulatory changes. So a general sense that clients are just being more hesitant on major new spending.
So that wider forecast range, the 0 to 3%, that really covers different potential economic scenarios playing out then.
Exactly. The low end, the zero growth, that kind of factors in a scenario where the economy weakens further. The top end, 3% growth, assumes things stay stable or maybe improve slightly as the year goes on.
Did they give any hints about how that growth might be composed? Any specific areas?
They did mention that the FY26 guidance assumes a reduction in revenue from third-party sources compared to FY25. That probably ties back to those deals that slipped in Q4 and maybe a more conservative approach there going forward.
Okay, let's switch gears slightly. Huge topic everywhere, obviously. AI, artificial intelligence. How is Infosys playing in that space?
AI is clearly a massive priority for them. They really emphasize growing demand from clients for AI partnerships.
Yeah.
And there's a noticeable shift towards what they're calling an AI-led transformation approach, using AI agents quite heavily.
AI agents sound specific. What are they actually talking about there?
Basically, AI-powered tools or systems designed to automate specific tasks, specific processes. Infosys claims they're really leading here, saying they've developed over 200 of these agents and are deploying them with clients now.
Over 200. That's quite a number. Can you give us some concrete examples of how they're being used?
Sure. They shared a few. For a U.S. financial services firm, they're using hyper-personalized conversational AI agents to improve the customer experience. For a European company, the goal is ambitious. Automate 70% of existing processes using these agents. And in telecom, building generative AI platforms with agents to really boost customer service operations.
Wow. Are they seeing benefits from using AI internally too, in their own operations?
Yes, they are. They reported productivity gains from AI in places like their Finacle banking software, seeing gains of 20–25%. Similar efficiency jumps in developing user interfaces too. All told, they mentioned they're working on about 400 AI-related projects right now.
So AI isn't just talk, it's really embedded in what they're doing and planning. Now, they also mentioned some strategic moves, expansions, acquisitions. What happened there?
Yeah, they highlighted strategic expansions in 3 key areas. An acquisition in energy consulting in the U.S., another in cybersecurity down in Australia, and adding a new strategic partner to their joint venture in Japan. Mitsubishi came in, which diluted Infosys' share slightly by about 2%.
Energy consulting, cyber, strengthening in Japan, all sound strategically important. What's the thinking behind these moves?
Well, it clearly fits with their strategy of broadening expertise and boosting their presence in high-growth sectors. They specifically called out the U.S. energy sector as critical. It's important to note, though, that the FY26 forecast doesn't include the impact from that energy consulting acquisition yet, because the deal hasn't closed. But they reckon it could add maybe 40 to 50 basis points to revenue growth for the full year, assuming it closes in Q1 FY26.
Got it. Okay, let's talk about the people aspect. Hiring, attrition, always key metrics in this industry. What did Infosys say?
They confirmed wage hikes went ahead as planned in January and April, and they reiterated their plan, hiring over 20,000 fresh graduates for FY26.
Now, hiring freshers has been in the news a bit recently, some reports of layoffs. Did Infosys address that?
They did, yeah, address it directly. Said they stand by their previous statements on the numbers involved. They explain their process. New hires get training, evaluation, actually 3 attempts at assessment tests. If someone doesn't pass after 3 tries, they try to find other opportunities, maybe support external training. They maintain the number affected was consistent with what they'd said before.
And overall headcount, employee turnover.
Total headcount was up year on year by about 6,000 people, and that includes the 15,000 freshers they brought in. Attrition for the year was 14.1%. They mentioned various reasons for people leaving, moving to GCCs, global capability centers, of other companies, competition, some leaving for further studies, that kind of thing.
Okay, let's circle back to profitability, those margins. They mentioned an initiative, Project Maximus. What's that about?
Right, Project Maximus. It's their internal program, focused on cost efficiency and boosting margins. They explained that the slight dip in operating margin in Q4 FY25, down 30 basis points, was mainly due to compensation costs and acquisition amortization. Those negatives were partly offset by lower post-sale support costs, benefits from Project Maximus, some helpful currency movements, and lower third-party costs.
And they sounded pretty confident about hitting their margin target for this year.
Yes, they reiterated confidence in staying within that 20% to 22% operating margin band for FY26. And they even said they're aiming to improve margins further, using Project Maximus to do it.
What are the main levers they're pulling within Project Maximus?
Several key tracks. Value-based selling, focusing on pricing deals based on the value delivered. Lean automation for operational efficiency. Improving performance in their critical portfolio, their core services, and better workforce utilization. They also mentioned a one-off benefit, an insurance claim payout related to a past cyber event, which helped their cost of sales numbers. And finally, they noted subcontractor costs continue to trend down on a full-year basis, something they're managing via Maximus for short-term needs and niche skills.
Okay, a multi-pronged effort on costs and efficiency. Let's get into the sector specifics now. How do they see things playing out across different industries?
Okay, starting with financial services, they expect budgets there to be, well, flat to maybe slightly higher, spending focused on AI, regulatory compliance, cost management. They see steady growth in capital markets, cards, and payments. And interestingly, a potential uptick in mortgage-related spending if interest rates fall.
What about manufacturing? That sector's faced some pressure.
Yeah, they expect more subdued spending there, longer decision cycles, driven by tariffs, market uncertainty, trade barriers. They specifically mentioned continued weakness in auto, especially in Europe. So the focus for clients is on cost takeouts, infrastructure transformation, IT consolidation, and some ERP modernization projects.
Retail's also had its challenges. Their view there.
They see retail as impacted by the economic uncertainty, lower consumer spending, expect tighter budgets, more caution, especially with tariffs mentioned, longer decision cycles for discretionary IT spend. Focus areas for retailers will likely be AI, cloud, modernizing their IT estates, and cost takeout.
How about energy, utilities, resources, and services, often a bit more resilient?
That sector continues to grow, strong pipeline for Infosys. They're seeing new opportunities in U.S. midstream and downstream energy, also more M&A and tax-related work and services, focusing on cloud migration, vendor consolidation. Utilities are prioritizing AI-driven transformation, so still quite active.
And communications, high-tech.
Communications, they expect that to remain soft. Pressure on discretionary spending continues. Growth likely from recent deal wins focused on cost reduction, AI, database work, cybersecurity. They did mention lower interest rates could help telco OEM profitability, maybe leading to more IT spend later. High-tech, most clients cautious. Macro headwinds, tariffs again. Discretionary spend under pressure. Also seeing margin pressure there due to heavy data center investments.
So quite a mixed bag across industries, reflecting those broader uncertainties. Let's revisit large deals. You mentioned the TCV was down year on year.
Yes, the total value was lower than the prior year, but they really emphasized the $11.6 billion in wins for FY25. And that 56% net new component, they view that as a strong performance, providing a good foundation, a good outlook for the future.
Is the nature of these big deals changing at all?
They pointed to a qualitative shift, yeah. Said generative AI is now part of almost every large deal discussion. It's impacting how they talk about productivity, processes, engineering, customer service, everything. They also see potential for more cost takeout and consolidation type deals given the current environment.
With all the tariff talk, how reliant is Infosys on the U.S. market? Are they looking elsewhere too?
Well, despite the uncertainties, they stressed a long-term positive view on tech and the U.S. market. Their recent energy consulting acquisition there kind of underlines that. But yes, they also highlighted ongoing expansion elsewhere, Japan, Australia. They did flag the slower auto sector in Europe as something they're watching. And interestingly, they said the U.S. public sector is a tiny part of their business, so minimal impact from anything happening there.
Return to office, still a big topic. What's Infosys' stance?
They described it as a flexible approach. Work from home, work from office. It's influenced quite a bit by client requirements. They are seeing more employees coming back to campus, though, and said they're getting positive feedback on the flexibility offered.
And finally, those tariffs again. How are they anticipating the potential impact?
They acknowledged ongoing client discussions about potential initial pressure, but nothing significant observed yet in terms of changes. Their guidance range, that 0 to 3%, factors in these kinds of uncertainties. They also said they're proactively positioning themselves to offer cost and efficiency solutions, supply chain optimization, to help clients if they are impacted by tariffs.
Okay, so wrapping up our deep dive here, it sounds like Infosys finished FY25 solidly, but they're bracing for potentially slower growth in FY26. That's mainly due to economic uncertainty, tariffs being a key factor mentioned. AI-led transformation is clearly a huge focus, a big opportunity for them. Strategic expansions are happening, and they're focused on holding margins through cost management, like Project Maximus.
That sums it up well. Hopefully this deep dive has given you, our listeners, a much quicker way to get the key takeaways from their recent updates without having to, sift through hours of transcripts yourself.
Right. So here's a final thought for you to chew on. Given the strong emphasis from Infosys on AI-driven efficiency and the potential rise of cost takeout deals in this climate, how might the traditional IT service models really evolve in the next few years? And what new skills, what new approaches might become most valuable both for service providers like Infosys and for the businesses that use them? Definitely something to think about.
And absolutely, if you want the full granularity, the transcripts are on the Infosys website. Worth a look if you want every detail.
Thanks for joining us for this deep dive. We'll catch you on the next one.